All right, so I'm going to try to, some of this will be a little redundant, what Peter already discussed, but I'm going to try to clarify what we're seeing throughout the investment sales market at this point. Brief bio, I've been a sales broker since 2009. I'm the president of a 25-member firm. We've sold over 400 properties, many of which are in Brooklyn, but also in Queens and Manhattan. In 2019, we closed 45 properties, and we have 20 under non-contingent contract coming into this year. And an interesting note is our sales volume was up 30% in the second half of 2019 versus the first half of 2019. So I thought that was pretty interesting. I'm going to try to clarify some trends that we're seeing in the market, and I'm also going to try to drill into where specifically we're seeing demand in the investment sales market at this point. My brief, overarching perspective is there's a lot of well-documented negatives at this point, but the market is very active. It's still very active, especially under $10 million. Over $10 million is less active, but there's a lot of liquidity. I think New York City is a great place for people and capital. There's a lot of new capital coming into New York, and there's people that want to be here, and there's companies that are moving here. So I think real estate in New York is going to do well, and that's my opinion on it. Some overarching trends we're seeing in the market. So as Peter said, the market's very nuanced at this point, and there's a lot of subcategories within asset classes. So the price and demand can vary drastically from one deal to the next, which we'll touch on to follow. A lot of the market is a cap rate market. There's a lot of 5 cap type of deals going on. A lot of buyers want to be buying in the 5 cap range. The value add days that we saw in previous markets are mostly over, but there are still some avenues for value add, which I'll get into as well. Demand, so the amount of buyers is far less than it was in the past, especially for fully rent stabilized tax class 2 buildings. But there's still enough demand, and buildings are still selling. There's buyers that materialize. Since June, for rent stabilized buildings, a lot of buyers were the older New York City families. But we're starting to see syndicators coming back into the market. We're seeing new funds being raised. We're seeing capital from other states targeting New York. Yesterday I was with a syndicated fund. They have money from Florida. They're trying to buy 20 properties in New York this year. So we're starting to see that. The big trend that we're seeing is it's a very sophisticated market. People really know what they're doing. Buyers are sophisticated. They know how to look at realty taxes. They're requesting RPIEs in some situations. They know how to look at the notice of property value. They understand the assessed value for realty taxes, the transitional assessed value. They really know how to figure out where is this building going. They're very well versed in looking for open permits, for any violations. So all those really start to play in to these transactions. The tenants are sophisticated. That goes without saying. There's been a lot of ads and information put towards tenants. Due diligence is a major issue when it comes to selling buildings, especially when people are looking back to 1984, and they can start asking questions about specific years that happened in the 90s or early 2000s. It can be very challenging, and that's a major obstacle to deals at this point with overcharge exposure. But some building owners are able to get through it, and those buildings will sell. And if you can't get through it, it makes it very tough to sell those buildings. I've also really noticed a flattening out of geographic locations and yield. So, for example, we're selling a 5 cap in Manhattan. We're selling a 5 cap in Prospect Heights. We're selling a 5 cap in Bed-Stuy. It's just kind of like a flat yield spectrum, and the neighborhoods aren't as important as they used to be. There is a drive to core locations, especially with the new rent laws, and the rent laws are gentrification stoppers in many ways. All right, so to drill in a little further, multifamily tax class 2 buildings, so these are buildings over 10 units where there's no tax increase protections. There's a few categories within this asset class that we're seeing action in. You have the fully rent stabilized buildings, you have partially rent stabilized, partially free market, you have fully free market, and you have tax abated properties. So starting with fully rent stabilized, there's a lot of money targeting buying these at 5 caps. A lot of raised capital, a lot of people want to buy these at 5 caps. We're still selling these below 5 caps. It's very situational. So we can sell a 3 to 4 cap if the price per unit and price per foot are very low. For example, we sold a 24 unit in Brooklyn at a 3.5 cap, but it was $100,000 a door, and the average rent was 6.8. So it was a low rent roll, low cap rate, and buyers just can't help themselves to buy these buildings at low cost basis that they feel like they've never seen, or at least not in the last 10 years. Generally speaking, for fully rent stabilized buildings, we think values are down 20 to 40%. It depends on locations and deals, but I think the locations that were hit the hardest are like the pride of ownership, like workforce housing type of locations. For example, Bensonhurst in Brooklyn. You used to be able to sell buildings there at 19 times the rent roll, 3.5 cap, and that's down significantly. Now that's more like 11 times the rent roll, and cap rates are pushing up towards 5% and a lot of that stuff. So GRMs are largely down from like the 12 to 19 range, depending on location, to the 9 to 11 range is what we're seeing. There's a lot of talk about price per unit GRM, which for quite a while we didn't hear any of that. It was all, for many years, it was all price per foot and cap rate. It was all basically like, where's the growth, where's the value add. Now it's people are just saying how many, what's the price per unit, how many times the rent roll. Buyers are really well versed, as I said, and I'll say it again, at expense increase exposure. They want to know where the realty tax is going. That's one of the biggest obstacles in these properties. And if the property is clean versus dirty, has a major impact on our ability to sell it. So stuff with open permits, stuff with HPD violations, stuff with AEP, that stuff is almost impossible to sell. Or the way you sell it is someone's going to want to get their cap rate, and they're going to discount out the cost to clean it up and do the work. So clean buildings are definitely in demand. Dirty ones are tough, and they're going to take a price hit. Okay, so then you have the partially or stabilized, partially free market buildings. These are for sure in demand. Anything with the word free market gets a lot of interest at this point. These are mostly cap rate deals. You have to have paperwork. If you can't substantiate rent increases, it could be very difficult. And for fully free market buildings, these are cap rate deals as well. The buyers are targeting a certain cap rate. These are absolutely in demand. You have to have good paperwork. In this category, buyers are looking at the expense increase exposure. So they're underwriting real estate tax increases, if any, and that plays a good role in those fully free market buildings. Then you have the tax abated buildings. There's a lot of these out there. You have 15-year 421As, 25-year 421As. We have the new Affordable New York program. You also have properties with J51s. So the pricing, so these are mostly cap rate deals, is what we're seeing, but buyers are discounting the tax increase exposure. So like how long you've left on your tax abatement has a major impact on the cap rate that you can achieve on these types of deals. We've sold some 421A properties recently, and it just depends on how long is left. But you probably see cap rates here, I'd say broadly and generally speaking, in the low 5 cap range to the mid 6 cap range, depending on how long is left on the abatement and how much the taxes are going to spike. And now we're starting to see these Affordable New York properties starting to roll out on the market. This is essentially a new asset class. These have a 35-year tax abatement, and 70% of the buildings are free market. So we haven't really seen that many of these hit the market yet, because this is a program, I think it started in 2016 after the 421A expired. But this looks to be a pretty promising segment of the market that we're definitely paying attention to going forward. All right, I'll bring it up. The tax class 2A and 2B buildings. This is a huge part of the market. These are buildings under 10 units. They have tax increase protections. So that's why buyers love these. There's a lot of capital targeting these. The increased protections are 8%. The taxes can't increase by more than 8% from one year to the next, or 30% in any 5-year period. So these have a lot of demand. Definitely more than the tax class 2, which is over 10 units, because there's clarity on the expense increase exposure. And it seems like there's still like a value add component to these types of deals. So people are talking about duplexing units, combining units. If you can get it far enough, people are talking about substantial rehabilitation to these properties. So I'll talk about that here as well. So the subcategories for buildings under 10 units that we're seeing is you have fully rent stabilized buildings, you have the partially rent stabilized, partially free market, you have fully free market, and then you have vacant buildings, which are rare, but they're out there. So for a fully rent stabilized tax class 2A or 2B building, there's so much money raised targeting these at like a 5 cap type of price. I'm not saying that's where these deals are getting done, but that's where a lot of capital is. And these properties, people are trying to underwrite, is there a value add play? Like, can you buy out tenants and maybe expand a unit or duplex or combine, or get the entire building vacant, do substantial rehabilitation? So there's definitely interest here. We're selling these in the 3% cap rate to 4 cap rate range. If the price per unit, price per foot are very low. We sold a building for a 3.5 cap. There's 120,000 a door, 130 a foot. It's a low cap rate, but people can't help themselves to buy when they, on these low rent roll deals where the cost basis is so low. We sold a building in Bestreich, it's a 6-family, it's 3.5% cap rate for $1 million. It's worth $2 million vacant. So you're starting to see those avenues. People are getting pretty aggressive on the cap rate depending on where they think they can take the property. For partially rent stabilized, partially free market buildings, there's so much demand targeting these buildings. For under 10 units, partially rent stabilized, partially free market, huge amount of capital for this stuff right now. We recently sold a portfolio of 8-unit buildings. They're 75% free market, 25% rent stabilized. These sold at 5.3 cap. It's $570,000 a door, $500 a foot, 15 times the rent roll. People think there could still be some buyout, value add potential, but it's all about the paperwork. It's all about showing individual apartment improvements, contractor receipts, everything that the buyer needs to see to make sure that those units are in fact free market if they're ever audited on that. Fully free market buildings, these are extremely in demand. For fully free market, where people think there's less upside, I think a lot of buyers would like to see these in the 5.5 to 6 cap range, but that's not where deals are getting done. Transactions are happening in the 4 3/4 to 5.5 cap range, broadly speaking, for fully free market tax class 2A and 2B buildings. We just sold a 10-unit building in Bed-Stuy at 5.3 cap, $600 a door, $700 a foot, 15 times the rent roll. I think those are pretty good numbers. And there's also there's a lot of interest in the fully free market buildings if buyers think the rents are below market and think there's a value add play. Those buildings will sell for lower cap rates. You'll probably sell those in the mid-4 cap range, and the buyers can try to raise the rents and renovate and build those up to like a 5.5 cap type of range. And then for vacant buildings, again, there's not many of them, but these are in demand. And it's basically like a redevelopment construction type of deal. People are taking construction financing or hard money. And the play is substantial rehabilitation, where someone's going to go in, renovate the entire building, and apply to DHCR that the building is deregulated based on their substantial rehabilitation. It's a little risky because you could have a vacant rent-stabilized building where you have the rent-stabilized rents and the building is vacant, and until you get DHCR's approval that it did qualify for substantial rehabilitation and is in fact free market, until you get that, it's a rent-stabilized building. So for someone to come in and invest however much to gut renovate a building, it's definitely risky, but these are selling for sure. Other stuff where other avenues we're seeing capital flow in the current market, development sites, they sell every single time we list one, they sell. We can't keep them in inventory. Brick buildings with air rights, so redevelopment type of properties, there's huge demand for this. 3 to 5 unit buildings, condo conversions, we sell a lot of these in good neighborhoods, Brownstone, Brooklyn. These are very in demand. We sell everything we touch here. Retail, I think retail is doing great. For all the talk that you read about online about e-commerce and retail not doing well, in terms of investor demand in New York City, it's very in demand. It just depends on the rents that you're getting and the cap rate that people get going in. Retail with air rights, this might be one of the most in-demand asset classes in the market because it's basically like your land banking, it's like a land bank, but you have cash flow and financing. So there's a lot of money targeting that. Mixed use is performing reasonably well depending on what the asset is. And out-of-state acquisitions, there's a lot of people who buy out-of-state. It comes up almost daily. Final thoughts here. There's a lot of frustration and confusion over the regulations. A lot of money targeting free market, and the good cause eviction I've seen it being priced in, but buyers are basically saying, like, where's the growth and can they buy out tenants? So they're just trying to figure out how do they get to the yield that they're targeting. There's a lot of buildings for sale. There's a lot of inventory on the market. And when I was a younger broker, the most important thing was having a listing. Today, it's having a buyer. You have to have a buyer that wants that asset class. You got to really know what the asset class is and who wants those kind of properties. Thus far, we're not seeing much distress or foreclosures at all in the multifamily space, only on construction deals. And I expect lender workouts to come as Peter talked about. The low interest rates are pretty much saving and propping up the market in many ways. And for rent stabilized buildings, I think it's a really good buying opportunity. And that's the sentiment of a lot of people out there. Buy good buildings at cap rates that cover and just sit on them, thinking that this regulatory environment, this too shall pass. So that's my sense on the market. Thank you.